I see traders spend months learning candlestick patterns, and for a lot of them, it doesn't actually make them better traders. So the real question isn't what candlesticks mean, it's whether they're even worth learning in the first place.
If you're new to markets, this probably sounds familiar. You open YouTube, search how to trade, and almost immediately, candlesticks show up. Doji, engulfing, morning star, evening star. You're told these patterns are the foundation of trading, so you memorize them, expecting clarity, expecting consistency. But then you place a trade and price does the exact opposite. That's where the confusion starts. Appeal of candlesticks is obvious. They make the chaotic movement of price look organized. They give us something to do. Most beginners follow a very specific path. They learn that a pin bar or a hammer at the bottom of a move means the price is going up. So they open a chart, find a hammer, and they go long. Then the price drops right through it. They assume they just need to learn more patterns. They add the engulfing pattern, the harami, the doji. Before long, their brain is a library of Japanese terminology. Here's the belief most traders start with. If I can read candlesticks correctly, I can predict what price will do next. And honestly, that belief sounds reasonable.
Yeah.
Candlesticks look precise. They look technical. They look like signals. But this is where things break down. Let's strip away the fancy names and look at what's actually happening on your screen. To use candlesticks correctly, you have to stop seeing them as pictures and start seeing them as data.
Okay.
Candlesticks don't predict price. They describe what already happened. Each candle is just a summary. Open, high, low, close. That's it. No intent, no future information, no built-in edge. The problem isn't candlesticks themselves, it's how they're used. Most beginners look at a candle in isolation. One pattern, one shape, one decision. But markets don't work in isolation. The same candlestick pattern can mean completely different things depending on where it appears. A bullish candle in the middle of nowhere? Usually meaningless. That same candle at a key level after a strong move with momentum slowing, now it's information. Candlesticks only make sense when you understand context, trend, structure, location, momentum. This is the part most people don't want to hear. Candlesticks won't save bad trading decisions. They won't fix poor risk management. They won't replace patience. And they won't magically tell you when to enter. Used alone, they're mostly noise. In trading, the words before are the market structure. Are we trending? Are we overextended? When you look at any candle, forget the name. Look at three things. The size of the body. This represents conviction. A large body means one side completely dominated the other. The length of the wicks. This represents rejection. It shows you where the price went but couldn't stay. The closing price. This is the final score of that round. The reason most hammer candles fail is that traders ignore where they happen.
I don't care.
If the market is in a parabolic crash, a tiny hammer isn't bullish. It's a sign that the bears took a 5-minute coffee break before continuing the sell-off. The candlestick is the last thing you should look at, not the first. It's the confirmation of a thesis you've already built, based on structure, volume, and volatility. So, are candlesticks useless? No, but they're often misunderstood. Candlesticks are best used to read behavior, not direction. Who's in control? Are buyers pushing or losing strength? Is momentum expanding or fading? A simple candle at the right location is more useful than a perfect pattern in the wrong place. Always ask, where is price reacting, not just what shape it formed? Candles just help you time it. Your idea should come from structure, levels, or context. So if you're spending all your time memorizing candlestick names, you might be focusing on the wrong thing. Used correctly, candlesticks add clarity. Used alone, they add confidence without an edge. If this helped, the next video will make even more sense. Subscribe if you want markets explained without hype, just probability, behavior, and risk.